Welcome to our presentation on the fascinating world of the Fibonacci ratio and its application in finance. Today, we will explore how this mathematical concept has been used to predict stock market price moves and discuss practical tips for traders to incorporate it into their strategies. With over a decade of experience in finance and trading, Robert Fischer has seen firsthand the power of the Fibonacci ratio in action. I hope to share his knowledge and insights with you to help you become a more successful trader. The Fibonacci ratio, also known as the golden ratio or Phi, is a mathematical concept that appears repeatedly in nature and has been applied to finance. It is derived from the Fibonacci sequence, which is a series of numbers where each number is the sum of the two preceding numbers, starting with 0 and 1. 0, 1, 1, 2, 3, 5, 8, 13, 21, etc. In finance, the Fibonacci ratio is used to identify potential support and resistance levels in the stock market. Traders use these levels to predict where the price of a stock may move next. The most common Fibonacci levels are 38.2%, 50%, and 61.8%, which are calculated by dividing a number in the Fibonacci sequence by the number that follows it. For example, 21 divided by 34 equals 0.618, or 61.8%. The Fibonacci ratio has a long history in finance, dating back to the 13th century when Italian mathematician Leonardo Fibonacci discovered the sequence of numbers that now bears his name. However, it wasn't until the 20th century that traders began applying the ratio to financial markets. One of the earliest examples of successful Fibonacci analysis in finance was in the 1930s, when trader Ralph Nelson Elliott used the ratio to develop his famous Elliott wave theory. This theory posits that stock prices move in waves, and that these waves can be predicted using Fibonacci ratios. When incorporating the Fibonacci ratio into your trading strategy, it's important to start by identifying the trend. The Fibonacci levels are most effective in a trending market, as they help identify areas of support and resistance. Once you've identified the trend, you can use the Fibonacci retracement tool to determine potential entry and exit points. Another way to use the Fibonacci ratio is to look for confluence with other technical indicators. For example, if you see a Fibonacci level that coincides with a moving average or a trend line, this can provide additional confirmation of a potential trade setup. However, it's important to note that the Fibonacci ratio should never be used in isolation and should always be used in conjunction with other technical analysis tools. While there are many benefits to using the Fibonacci ratio in your trading strategy, such as providing clear entry and exit points and helping to manage risk, there are also potential drawbacks. One potential drawback is that the Fibonacci levels are subjective and can vary depending on the trader's interpretation. Additionally, the Fibonacci ratio is not always accurate and should never be relied upon as the sole basis for making trading decisions. One trader, who we will call Trader A, used the Fibonacci ratio to predict a significant drop in the price of a particular stock. Using technical analysis and the Fibonacci retracement levels, Trader A was able to accurately predict the stock's decline and make a profitable trade. Another trader, who we will call Trader B, used the Fibonacci ratio to identify a key support level for a different stock. By analyzing the stock's previous price movements and applying the Fibonacci levels, Trader B was able to buy the stock at a low point and sell it at a higher price, resulting in a substantial profit. In conclusion, we have learned that the Fibonacci ratio is a powerful tool for predicting stock market price moves. By understanding the history of its use in finance and learning how to apply it to our own trading strategies, we can increase our chances of success in the market. Remember, incorporating the Fibonacci ratio into your trading strategy is not a guarantee of success, but it can provide valuable insights and help you make more informed decisions. We encourage you to explore this concept further and see how it can benefit your own trading practices. Thanks for watching. Like and subscribe, and we will catch you on the next one.